Yipper. Rob, the email we received for you is, I've been looking for a home for a while and was pre-approved by a lender. How long is my pre-approval code? All right. That there. Mark, you got some good stuff for us again?
Of course.
Love this guy. All right. Away we go. You all set? Rob, you got some good stuff too?
Yeah.
Okay, good. Here we go. Welcome. You're listening to The Best of Investing on Talk 910. I'm Edward Brown, your host, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, one of California's fastest growing mortgage investment firms, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Use that number to answer the trivia questions for 3 vacations given away during this show. And the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Those vacations are free. Their only request is a $75 cleaning fee to cover the housekeeping expenses. Today's trivia theme is the skeleton in my closet.
Ooh, okay.
Kind of weird. Okay.
I don't know what you're talking about.
Yeah, you'll know when we start talking skeletons. Okay. Our website is bestofinvesting.com. Check us out on television, Comcast Channel 26, AT&T Channel 99, Saturdays at noon, Sundays at 6 p.m. Rob, why don't you start with us?
Oh, I was going to let Mark start. Mark's
Okay,
got
Mark?
really good
Oh,
information.
I got a great one
Okay.
here, and I was waiting for Rob to be on the show so we can talk about this one. It's for those of you who may have been frustrated over the last couple of years dealing with the banks and their new rigid lending guidelines. Might be pleased to hear that the House of Representatives voted last week to change the definition of qualified mortgage, opening the door to potentially seismic changes in the mortgage lending landscape. And why I love this article is because it talks about basically modifying or simplifying the qualified mortgage definition for certain types of banks. And of course, on the other side of the aisle, those people who are behind the creation of the Consumer Finance Protection Bureau, what is it,
That's right.
CFPB,
yeah.
of course, are very much against it. Again, it's starting to, it's one of these things that pits the Republicans versus the Democrats in
Yeah,
many ways.
it does fall down party lines, I mean, for the most part.
Yeah, so anyway, the House approved the so-called Portfolio Lending and Mortgage Access Act. We always come up with these crazy names that don't mean anything, but essentially what they're saying is that this new qualified mortgage rule would recognize all residential mortgage loans held in portfolio.
Okay.
We'll talk about what that means. By credit unions and other lenders, those would all be considered qualified mortgages for purposes of the Consumer Financial Protection Bureau's mortgage lending
I know where they're going
rules.
with this. Yep.
And so, basically, the qualified mortgage is a term that was recently created and was enacted. Was enacted in 2014, right? 2014 was the beginning of it. Or was it 2015?
I want to say it was before that.
Yeah,
but yeah.
But the qualified mortgage is essentially the rules
You're
around
probably right about
a
2014.
mortgage
Yeah.
that qualifies for the lender for protection from a lawsuit. Basically, if you do the following things, you're basically considered, that loan is considered to be a qualified mortgage, and all qualified mortgages exist in what's called a safe harbor, meaning they can't be sued by the borrowers for making that loan. So, presumably, a qualified mortgage does not have any predatory lending characteristics, features, right? And if you've been listening to our show for any length of time, you've heard us lament about the so-called, what's now considered predatory lending practices. Dodd-Frank came up with a whole list of things that, in my professional opinion, are not predatory in nature. In fact, many borrowers like these features.
But they've been grouped with
But they've been grouped
those.
with those. So
Throwing out the
anyway,
baby with the bathwater kind of thing.
So anyway, under this revision of the bill, this bill, depository institutions that hold a loan in portfolio, meaning they're not selling it, they're not like wrapping it up into some fancy schmancy, security and selling it off. They're actually holding it in their own portfolio. Those banks would receive a legal safe harbor even if the loan contains terms and features that are considered abusive and harmful to consumers. And this is why I had to highlight this, because this just gets my blood boiling. So let's talk about abusive and harmful lending practices. So did you know that an interest-only payment is considered abusive and harmful? Even though all we make with Pacific Crowd of Money are interest-only payments, and my borrowers love them and my lenders love them.
How about an interest-only payment on a home equity line of credit? That's not abusive.
Right.
That falls outside of Dodd-Frank.
Balloon payments are considered abusive and harmful. So if,
So everything has to be a fully amortized
right.
loan.
So if it has to be a fully amortized loan. But what if you want to lower interest rates? You know you're not going to live in the home for that long, and you want a 5-year ARM. Well,
Right.
It's
So wait a minute, if you can't have interest only and you can't have a balloon payment, you got to go for 30-year or 5-year, whatever the
Right. So
your
your choices on the residential side are you do a 30 or a 15-year fixed, or you do a hybrid ARM, a 5, a 7, or a 10-year ARM, which is fixed for that initial period.
Yeah, but I'm sure at some point they're going to say adjustable rate mortgages. That's abusive.
They could.
Right? Because interest rates could go up.
They could do that. Yeah.
So basically, this law would relax certain restrictions and certain features for loans that would be held in portfolio, and this is really important because when you look at portfolio lenders, this is really a law that was backed by the Independent Community Bankers Associations. What they say is that 73% of community bankers have decreased their mortgage business or completely stopped providing mortgages due to the expense of complying with the regulatory burdens of Dodd-Frank.
Okay, so I'm wondering, how many people do we have to hire?
Our bank has complete new departments that deal with the compliance aspects.
So you start throwing in the salaries of all those people, and
Consumer
they go,
bears all
we're
the
just
cost.
not making enough money.
Right, and they're saying 1 out of 5 Americans who borrowed to buy a home just 5 years ago will not meet the underwriting requirements of today's mortgage rules.
One other striking component of Dodd-Frank and the QM rule is this, that a vast majority of loans we make on the residential side are packaged and sold to Fannie and Freddie, right? Fannie Mae, Freddie Mac, and they end up being bundled into mortgage-backed securities, as you talked about before. So if you make a Fannie, Freddie, FHA, or VA loan with a debt-to-income ratio over 43%, you can still have a qualified mortgage. So a government-backed loan with a 44% debt-to-income ratio can still be qualified. What these guys are saying is, if I make a 44% back-end ratio, now I don't have a QM. And so you're putting it on, you have a double standard for the same loan. So if you go to a portfolio lender, Luther Burbank, for example, Union Bank of California, there's a million of them out there, and they all do a great job in their own way. If you go to get a $500,000 loan from Union Bank of California on a 30-year fixed rate program, they're a portfolio lender, they have to make a 43% hard and fast ratio.
Yep.
You go to a residential mortgage lender who will make a Fannie Mac loan, now you can push that ratio as high as 50%, and it'd still be QM.
Yeah, some of the quotes I like in this, of course, this pits the right against the left, and proponents of this say it should not be the job of Congress or unelected and unaccountable Washington regulators to decide who gets a mortgage and who does not, or to force community banks and credit unions to function like regulated utilities, issuing only plain vanilla mortgages rubber stamped in Washington. And I love that because again,
all wear brown suits.
Again, so what this bill is not proposing to do is to do away with the reforms. That's not that's not what they're trying to do. But what they're saying is let the community banks be community banks and make loans that they feel are smart loans. They're going to hold them in their portfolio. They're not going to wrap them up like a security and sell it like derivatives like we did before. And let them make these loans and give them the qualified mortgage protection so they can't be sued by unscrupulous attorneys.
Smart. Consumers need to be babysat.
Well, so I want to tie in an article to that. It's not directly related, but I think it speaks to the fact that you've got community banks who are predominantly trying to serve their community. Makes sense. They've done it for years. For the most part, it's worked well. I have an article here that says, a rare occurrence, the geography and race of mortgages over $500,000, released today by the National Low Income Housing Coalition, reveals that only 5% of the mortgages obtained in the past 3 years in the U.S. were larger than $500,000, and that lowering the mortgage interest deduction cap to $500,000 would have no impact on the majority of homeowners nationwide, given the rarity of mortgages over that amount.
Nice. Oh my goodness.
Well, Southern California real estate will now be worth $500,000.
Well, so there you go. You're talking about a community trying to serve, or a community bank trying to serve its community, And you're also talking about how it is impossible for the government, the larger government, to dictate what serves the best interests of consumers in a specific area. And what a lot of this regulation does is it prevents those banks from being light on their feet and best serving the consumers in their neighborhood. That's what I have a problem with.
What about those houses that are worth like $20 million?
Well, I don't know if a mortgage interest deduction is really even a relevant thing to them, but yeah, there's a lot of people here that live in houses that max that out.
Well, and kind of going back to what we were originally talking about in the beginning here is so this is kind of this proposed bill that did pass the House. Now it has to go to the Senate, and it's threatened to be vetoed by the president. Is the first of probably many tests to the Dodd-Frank legislation, and in many ways, it was such a huge and overreaching, in my opinion, regulation and regulatory burden that I think it's prudent to go back and look at some of the weaknesses and some of the unintended consequences. But then you have officials like Representative Maxine Waters, not my favorite Democrat, who just spouts the Democrat line that says this bill would allow lenders to deal in the same kind of risky loans that sank Washington Mutual, Wachovia, Countrywide, and eventually the entire economy in 2008. The bill would undermine the anti-predatory lending provisions of the Dodd-Frank Act and virtually eliminate one of the most significant consumer protection rules implemented by the CFPB. What a load of crap.
Yeah, and this is the one thing I've talked with a lot of individuals about this, and when you talk to smart people, they'll give you the other perspective. They won't just toe the line and agree with you. And so people will say, my wife is one. She'll say, well, isn't there any good in that bill? What have they done that actually does protect consumers? And yeah, there are things in there that have regulated facets of the loan process that I think is helpful. They've normalized things. They've made things easier to understand. But what they've done and the way they've gone about doing it has been to just restrict so much the flexibility of how things get done and the cost with which it takes to comply to the regulation. It does put a real burden on it.
Too much of the free market away.
Overreaching.
Okay. Overreaching is a great way to express it.
All right, guys, here we're going to cut to our first commercial break. Before we do, we got a little shout out here for Dr. Vadim, 415-992-5160. He does dental implants. He's experienced specialist, and he's doing implants, abutments, and crowns for only abutments for only $1,998. Which, if you know anything about implants and stuff, that's pretty darn cheap. And he's doing it to try to attract new patients. So give him a call, 415-992-5160. Ask him about his dental implant services. All right, here's our first trivia question about Skeleton in My Closet. On November 6th, 1963, which future first lady, thank you, ran a stop sign in Midland, Texas, and broadsided another car, killing the driver? The first caller with the correct answer was a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer this question. On November 6th, 1963, which future first lady ran a stop sign in Midland, Texas, and broadsided another car, killing the driver? Stay with us. The Best of Investing will be right back. Okay. But it's interesting. I got a call from Rama Capital because they're trying to sell some of their loans and stuff. So that's why I said, hey, I got you on the phone. I said, why did your guys' yield drop? And he goes, well, we had some huge payoffs, and we didn't leverage it at all because we just had to pay down the loan. Well, how about you guys writing your loans for? See, that's they have to leverage it in order to give a little bit better yield, but then you're talking much more risk. Yeah, very interesting. I thought you'd like that.
I do.
It's a Simpsons thing.
That's
right?
a Simpsons, yeah.
The bad kid.
Yeah, I don't remember his name anymore. I haven't watched Simpsons for years.
Oh, yeah.
It's all Family Guy now.
I keep missing.
Or South Park. South Park's just terrible. It's so nasty.
It's funny because I missed. My brother got into that, and I guess I just didn't. I knew there was.
It's just the most crass humor. You think Family Guy's crass? South Park is just over the top.
Over the top.
Don't let your kids watch it.
Okay. I don't let the kids watch it.
What do you want to do next? Because we definitely got to talk about the TRID crap.
Yeah, I think we can go into that.
Okay.
Okay.
All right, ready? Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. We cut to the first commercial break. We asked this trivia question about the skeleton in my closet. On November 6th, 1963, which future First Lady ran a stop sign in Midland, Texas, and broadsided another car, killing a driver? I'll give you a hint, it was not Dolly Madison.
Lady Bird Johnson.
Wait.
That's what I would have thought. No, it was Laura Bush.
Oh,
Wow.
Yeah, George Bo's
Yeah.
wife.
W's.
W.
wow.
Yeah,
She must have been pretty young back then.
I think 63 must have been.
Yeah.
So Rob and I were talking actually before the show, we were talking about
Yeah.
the impact this past month of a new set of regulations that affect mortgage lending that not a lot of people in the public are familiar with. I mean,
Right.
If you're a real estate professional, you have absolutely heard of the word TRID,
Right.
which is an acronym for something that I know.
Taylor Rusma integrated this.
Yeah, I knew you had it memorized.
Oh, we have it
but,
memorized.
Wait,
You
you
know-
said something disorders?
Yeah, it is. We'll get into that.
Yeah,
One escrow officer put her signature file saying it was the reason I drink. so Mark, keep going with your thoughts there.
Well, I've been what I told Rob before the show is, I've been reading. I keep up with all the blog reports and studying for the doing my show notes and stuff. And I came across several articles this week that purported to say that the hiccup in the mortgage lending business, thanks to TRID, which went into effect October 1st of this year.
Yeah.
Are largely over, and everything's back to normal again. And I did not believe
Wow,
that for a
yeah.
minute. I just shared that with Rob, and he just about went apoplectic over it. So-
and it just stunned me too.
You were saying something about escrow officers and realtors and mortgage brokers coming to blows over this.
Yeah, it's been a real
verbal and
challenge.
otherwise.
So I think if you're out there and you're in the process of trying to buy a home now, you probably have a grasp on this. And we all knew this was coming, so the industry spent an inordinate amount of time trying to get ready for it, and time and money to get ready for it, rebuilding new systems, new software, you name it, because everything changes with this redisclosure protocol. So what a lot of people were focused on, and a lot of real estate agents were focused on, is the fact that the buyer, or the borrower, I should say, now has a mandatory 3-day waiting period to inspect their closing disclosure. So the way things,
Supposedly a good thing.
yeah,
in theory.
and the intent again is pure. The intent is that
Yes.
people were being rushed into signings and they didn't know what they were signing, and they go ahead and went ahead and just blindly signed what was put in front of them. Now, however, if you give them 3 days to review their documents, we deem that to be a sufficient amount of time for them to understand what they're really doing. The problem with this mandatory 3-day wait is that oftentimes you have buyers who need to move. They have a contingent sale, they have moving trucks, they have other things. And so what we're finding in the industry is you're going back to the buyer and their agents, and they're screaming at you saying, when are my loan documents going to be in escrow? When is this loan going to be funded? And you're telling them they have to wait 3 days before they can sign. And they're saying, why do I understand what I'm doing. I've seen the documents 10,000 times. Why am I waiting? And you're saying because this rule is in place to protect your consumer.
In theory, then, should they be starting 3 days before?
Yeah, but you only
Well,
have a
30
certain,
days before.
you only have a certain amount of days in the contract, and unfortunately here in the Bay Area, we are still in a very competitive environment where time is of the essence, and contracts are written 30, 45 days, and that you bring up a good point, Edward. So shouldn't there be more time? The answer is yes, there should. Then there's the reality of the market, but also what our industry did, I think, a not so good job of is we underestimated the amount of time at the beginning of the process.
Yeah.
What I mean by that is everybody's focused on the 3-day window, and rightly so, but here at the beginning now, remember that what Dodd-Frank aims to do is make all inaccuracies the responsibility of the lender, regardless, okay? So lenders are being extra careful with how they prepare these documents because they're going to be held accountable for anything that goes wrong. So lenders are saying, hold on a second, I'm not sending this thing out until it's right. So if I need information from the insurance company, if I need information from the escrow company, if I need information from the borrower, the seller, whoever it may be, I'm going to get it. So while all that happens, a day goes by, 2 days go by, a weekend goes by, a holiday goes by. Now you arrive at that period where they should be closing, and you're telling them, now you get to wait 3 days.
Yeah.
That's what's been happening over the last month as everybody gets used to this new system.
Right. The implementation of this has been extremely challenging, and Rob's absolutely right. Even in our business, the hard money lending business, since we do consumer loans, we're running up against the same thing. And so there's just, it used to be you give them a loan estimate. A loan estimate is just that. It's an estimate. Here's an estimate of charges. Well, now we're no longer allowed to estimate. We're actually supposed to figure out exactly what that loan is going to cost and every line item on that loan.
Right. And be held to
Days,
tolerances.
if not
Yeah,
weeks before the loan closes, and we're having to disclose and redisclose and redisclose again. Very, very simple loans, and every time you redisclose, there's another 3-day waiting period. I mean, it's just beyond the veil.
Let me give you some backdrop on the Consumer Financial Protections Bureau take on the loan estimate. Mark, you just touched on it, a great point. So it used to be, until RESPA integrated disclosure means they're combining the truth in lending statement with the good faith estimate. Good. Now, the three of us are here, right? If I said it's a good faith estimate, what do you infer from that?
That it's just an estimation.
And I'm doing
it in good faith.
I'm doing it in good faith.
You're
Okay.
trying your very best to be honest.
Well, the good faith estimate is being replaced in the new trade environment with what's known as a loan estimate, LE. Okay, so here's how the CFPB defines a loan estimate and how it works. Generally, quote, generally, if a charge paid by or imposed on the consumer exceeds the amount originally disclosed on the loan estimate, it is not in good faith, regardless of whether the creditor later discovers a technical error, miscalculation, or underestimation of a charge.
But how is there a fudge factor or
No.
de minimis?
There are tolerances that's a little more complicated once you get into
They're
that.
tiny
But
tolerances.
let me go on with.
Yeah.
However, take that logic, right? However, a loan estimate is considered to be in good faith if the creditor charges the consumer less than the amount disclosed on the loan estimate.
Gee, really?
Without regard to any tolerance limitations. So
Yeah, obviously, if you say it's going to cost $1,000 and it costs $900, so yeah,
But
then you know. Wait, hold on. So now I'm going to say it's going to cost you $50 million.
And
Right?
thank you, Edward. We'll get to that point
Okay.
in just a second. So here's the way I look at it. I mean, look, I know there are consumers out there saying, "Hey, good, I'm glad they finally pinned the lender's feet down now and they got it all." But look at it if you were a doctor, right, or a surgeon.
Yeah.
Generally, the surgery went well if it went exactly. Then the surgery was in good faith if the outcome was what they hoped.
Yeah.
It was not in good faith, meaning the surgeon had ill intent if it didn't go the way he's planned. Can you imagine if that were medical doctrine or medical regulation? In other words, if they could come back to a surgeon and say, you did not act in good faith because you lost the patient because of a technical reason.
Very quiet. There may be some Congress people listening who want to do that.
So anyway, and to your point, Edward, what I will say is that the industry is just scared out of its skull, and over-disclosure is one of the things that we're really grappling
Yeah, but what's going to happen is, I mean, I can just imagine, right? A loan, let's say it's supposed to cost $5,000 in fees.
Right.
The lender what's going to happen is the broker is going to say, listen, you got to sign this thing that says we're estimating it's going to be $8,000, but I'm telling you right now it's going to be less. However, I'm doing this to protect blah 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 blah. Right?
Yep. And some lenders will lose business that way. Some lenders will gain business that way. But at the end of the day, what that does is further confuse and delay the process because the consumer has to weed out whether this guy's telling me the truth or if he's just trying to pull one over on me. And I don't think as an ethical lender, that's a position you want to be in. You want to be able to say, guys, this is what I believe it's going to cost. I'm a professional. I'm making a good faith estimate.
Exactly.
And it should be
Well, I
very
got to
close
ask
to
you.
this.
Okay, so we had an email here that kind of fit into what you were talking
Sure.
about before, and so I want to ask you this: a borrower, or excuse me, an email question from a listener comes in and says, "I've been looking for a home for a while and was pre-approved by a lender already. How long is my pre-approval good for?"
Pre-approval is generally good for 3 months with RPM Mortgage, and that is because the credit report will expire in 90 days. However, all of your pre-approvals, just about for everybody, are living documents, meaning that your pay stubs must constantly be updated, your bank statements, theirs are going to change on a weekly or bi-weekly, monthly basis, whatever it is. And then clearly when we cross the end of the year, 12/31, now you're going to be issued a W-2 likely in January, February. And if you're self-employed, you're going to close out your books for the year. So all of those deadlines apply in this case. So your pre-approval is generally good for 3 months unless an event occurs which would materially change your assets, your income, or your credit.
Okay.
Yeah.
So, Rob, you've been giving us a lot of good information. I know there's going to be a lot of questions out there by
Sure.
listeners who are wondering about house loans. Please give them your information.
My bio is here on the Best of Investing website. Happy to be part of the show. And I work out of the Mill Valley office of RPM Mortgage, located just north of San Francisco off the 101. You may have driven by our building, 415-367-5959, and Google Rob Spinoza. All my contact information is out there somewhere.
There you go. Okay, we're going to cut to our second commercial break. Before we do, make another mention here for Pacific Trade Exchange, business-to-business bartering exchange. If you don't know anything about it, you got to give them a call or check out their website, Pacific Trade Exchange. Ask for Brian Capehart. He'll explain all about it. It's a way to do business and not have to worry about spending cash. It's a good deal. Okay, here's our skeleton in the closet. Question number 2. Which member of the Rock and Roll Hall of Fame was found guilty of murder in 2009 and sentenced to 19 years to life in the slaying of actress Lana Clarkson? All right, first caller with the correct answer wins a free 3-day 2-night stay at the Lighthouse Resort. Call 888-912-1190 to answer that question. Which member of the Rock and Roll Hall of Fame was found guilty of murder in 2009, sentenced to 19 years to life in the slaying of actress Lana Clarkson? Stay with us. You're listening to The Best of Investing. We will be right back.
We're flying.
We are flying. Yeah, I gotta go to a dinner thing myself. Yeah. Mark will get into your email. How's that?
Yeah.
Mark, what was the Norris report?
Yeah, the Norris report. Actually, no, it says, the Norris Group. Just Google the Norris Group, and then go to their blog. I used to check dozens, and now I just go to the Norris Group's blog, and it's just yeah. Every day they have I was telling Rob, they do this consolidated post that pulls a lot of articles from all over the internet.
Cool. You guys ready?
Yep.
Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. Here was our second trivia question about skeletons in my closet. Which member of the Rock and Roll Hall of Fame was found guilty of murder in 2009 and sentenced to 19 years to life in the slaying of actress Lana Clarkson?
Wow, I don't know that.
Phil Spector.
Phil Spector,
Oh,
that is
that's
correct.
right.
Very good.
I got
Wall
all
of
that.
Sound.
What's that?
The Wall of Sound.
The Wall of Sound.
Architect of the Wall of Sound.
Mark, we got a nice little simple email question from a listener. Just says, where can I learn more about deed of trust investing?
Well, there's this thing called Google,
Yeah.
or the Google.
The Google.
No, in all seriousness, that's what companies like us are here for. Pacific Private Money, we take callers daily. People calling for more information about what is mortgage investing and what is trust deed investing and what is a mortgage pool fund and what are the risk factors and safety and security features of participating in mortgage investing. And our website, pacificprivatemoney.com, is a good way to access some of that information. But I will tell you that there actually are some great articles available on the internet about trust deed investing and things that you should be aware of if you're going to invest in individual notes. Because I will tell you that individual note investing is not for the faint of heart. And we work with several dozen very experienced note investors at Pacific Private Money. If you're one of them and you want access to even a larger portfolio of investment options, you definitely want to give us a call and we'll add you to our distribution list of individual note investment opportunities. But we also, for people who are absolutely interested in how to earn 8% or more on their money, but have never invested in a deed of trust secured note and probably might have a difficult time competing against people who are making very, very fast decisions about note investing because they do go very quickly. There's such a strong demand for quality real estate secured notes that people with money who are actively participating in this. In fact, many people are retired real estate professionals who literally their full-time hobby at this point, since they are retired, is keeping their money invested in real estate secured notes. So it's hard to compete with guys like that are really just
always have their finger on the
yeah,
pulse.
exactly right. They got their finger on the button.
Yeah.
I got an answer for that. I want it. Mortgage pool funds are an option for you, and they have actually a lot of interesting features that I think make them a very compelling and, in fact, superior in many ways to trying to compete with the pros on individual note investing. And in many ways, it's almost like the stock market. You try to pick individual stocks and compete with the pros, and a lot of people believe that the stock market, like many markets, is a rigged game, and it's hard for the individual to compete with the big boys and the guys that are doing that rapid investing, or they call that stuff, and in many ways, note investing or mortgage investing or individual deed of trust investing. It goes by many different names. In many ways, that is a similar experience. It's hard to compete with the big boys. So how do you benefit like they do, like the banks? How do you make money more than the 0.25% that you can earn in a money market account today? And at the Pacific Money Fund, we've been paying a little more than 8% consistently now for going on 28 months since we created the fund. And we created the fund because we found that we were getting an overwhelming response from people in the Bay Area who wanted to know how they could make 8% or more on their money as well. So for more information on that, go to our website. We actually have two websites. We have a website specifically for our fund, and that's pacificmoneyfund.com. That's pacificmoneyfund.com. There's information on there, but really the way to get the most detailed information is to put your name and email address in the sign-up form. That's at our website, and we'll shoot you some information in the form of a PDF attachment to an email that you can read at your leisure. And if you think this is something for you, you can call us back and get more information, or come meet with us at our offices. We're located in downtown Novato. We're happy to meet with you. In fact, I meet several times a week with people who drive from all over the Bay Area to meet with us. They want to look at the whites of our eyes and see that we've got a real operation and a real company. And of course you should, because this is your retirement savings we're talking about. We help hundreds of people in the Bay Area earn stellar returns on a portion of their savings. I think everyone should be looking at how they hold a diversified portfolio of investments, and you should really be looking at mortgage-backed investments to boost the yield that you earn on your savings and retirement accounts. And again, we've been paying over 8% consistently on what we believe to be a conservative and well-secured mortgage pool fund. Right now, we're at a weighted average loan-to-value of 55%.
Wow.
So we're not talking 80 or 90 or 97% mortgages here. We're talking about mostly first position mortgages that are well secured by Bay Area real estate. So again, pacificmoneyfund.com, pacificmoneyfund.com, or just call us, leave a message. I'll give you a call back next week. 415-883-2150.
And any specific deals of the week? You want to give an example?
Well, the most popular loan we're doing right now, Edward, and you know this because we're always talking about the deal flow, and it is these owner-occupied bridge loans. People who, and these are consumer loans, and a lot of private money lenders don't touch consumer loans, which is what confuses a lot of people out there who might call other private or hard money lenders in California or the Bay Area and find out, well, I'm sorry, we don't make loans to people who are buying a primary residence. And we do at Pacific Private Money. We're one of the few companies in California actually that are actively engaged in making consumer loans. And again, why is that? Well, it's because thanks to all the Dodd-Frank regulations, a lot of people have gotten out of making consumer loans privately because of all the added regulatory and paper burden. But we've got good attorneys, and we've invested in our underwriting guidelines so that we make good and smart loans to people who need them. And so probably the most common loan we make is someone is a family who wants to either move up or move down, but they don't want to sell the house they live in first.
Right.
They want to find the house they want to move to and buy it. And in the old days, you could just call your bank or your mortgage broker and you could get a loan to buy that second home. And when lending was a lot less restrictive, but today in 2015, many people are finding that they don't, especially if they're self-employed,
Right.
they can't represent enough income
Carry both.
to carry two mortgages in the new age of qualified mortgage underwriting. So we help a lot of people with what we call our short-term, 11-month, no prepayment penalty bridge loan that helps you acquire whatever property you want. Look, it's not cheap money. We don't make money at bank rates. That's the downside. The average loan we make costs 10% on the note rate, but there's no prepayment penalty, and you may only need it for 3 or 4 or 5 months until you can sell your other home and then qualify to refinance conventionally. So
Yeah.
again, it's a tool.
The angle on that too is that if that private money bridge loan allows you to go in and buy that other property outright, you may get a better deal on it and close a lot quicker, and the cost of that money may end up coming back to you over the transaction.
Well, and I work with and I work with companies like Rob at RPM Mortgage who have clients that are in this situation that they can't qualify them today for that loan to buy that home they want. So they come to a company like Pacific Private Money. We arrange for them a short-term bridge loan, and we help them capture that property. And
Right.
then when they sell their existing home,
Property one.
then
Yeah.
then Rob takes them out with one of his great loan programs at 4% or better.
Right.
And then again, no prepayment penalty on these bridge loans, so you pay it off whenever you want.
Again, how do people get a hold of you?
So PacificPrivateMoney.com or 415-883-2150.
All right, we're going to go to our last commercial break here. Again, the theme is Skeleton in My Closet. Which governor of Illinois, UN ambassador, and two-time American presidential nominee accidentally shot and killed another child when he was a 12-year-old boy in 1912? The first caller with the correct answer is going to win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Which governor of Illinois, UN ambassador, and two-time American presidential nominee accidentally shot and killed another child when he was a 12-year-old boy in 1912? A little sad story there. Apparently it affected him for the rest of his life, which I can imagine it would.
Yeah.
All right, stay tuned. You're listening to The Best in Investing. When we come back, we're going to have some closing comments.
Taft.
No. Taft.
No, he was actually a president.
President
Yeah, he
in
was
1912.
I can't think of the guy's name.
You'll know.
but
You'll know.
It'll come to me. No, it'll come to me.
And
It's
in fact,
such a unique name, right?
It is.
Yeah.
And he probably should have been president. I mean, very brilliant guy, apparently.
What else you got?
It's not.
Rob?
It's,
You got some
it's
goodies?
not Spiro Agnew.
Spiral Agnew.
It's
It's football.
Spyro Gyro.
What do you guys want to come on in the last one? So I'll tell you how much time we got.
Okay.
Talk about interest rates going up, or
Yeah, we can talk about that. I have some stuff on that too.
I just love this graph I pulled off of Case Shiller that I hadn't seen it before, but this is with the January 2000 is their 100 index. So they've got it 88 through 15. So how many years is that? Because that's not quite 30 years, but
25.
yeah, 20. Oh, yeah.
A little
done.
more than that, yeah,
So 25
27.
years, but it breaks up the graph, and this is San Francisco Bay Area homes over $1 million, homes 500 to $1 million, and homes under 500,000. And the biggest bubble. So as of today, we're still 23% below the peak for homes in the Bay Area under 500. We're same as the peak for 500 to $1 million, and 17% higher on
Yeah,
homes $1 million
yeah.
and above.
Guys, ready? Let's close this up.
Interesting. Yeah. How many minutes?
11 and a half.
Oh, okay.
Well, welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host, along with Mark Hahn, and along with Rob Spinoza.
I can't think of that name.
Yeah, third trivia question. Which governor of Illinois, UN ambassador, and two-time American presidential nominee accidentally shot and killed another child when he was a 12-year-old boy. Actually killed a 12-year-old boy in 1912.
He's got a funny name.
He does.
And I can't.
Last name's normal. First name's not normal.
Yeah, and I can't.
Ready?
Yeah.
Adlai Stevenson.
Adlai
That's
Stevenson.
it.
Ah!
I knew that was the one you were thinking of. Yes. Apparently, that guy was really, 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 really brilliant.
Really
In fact,
bright.
he was a little too smart for the average person. That's why they voted for Eisenhower instead of him.
Oh, well, going up against Eisenhower in the 50s.
That was tough.
Yeah, I'll put that. Well, I don't want to get into Nixon, but apparently that was a rap on Nixon too. He's a very bright guy.
Yeah.
Had his problems with ethics.
But I am not a crook.
If the president says it, then it's true, right?
Exactly.
It's kind of like the CFPB. If it's done in one way, it's good faith. If it's not, it's bad faith.
Yeah. So Rob, all bets are that the Fed is going to raise rates
Yeah.
on us this month.
Yeah.
Or December rather. So, what do you think is likely to happen with mortgage rates as a result? Because not everyone is aware in the public that just because the Fed raises rates doesn't
point.
necessarily mean that mortgage rates will go up, but they probably will, at least initially, I would imagine.
Well, what we saw is there was an interesting set of economic reports that came out through the late summer and into the last employment report we got in early November. So I think it was November 6th or 5th or 6th, whatever that was. And up until that point, it was sort of 50-50. I think a lot of economists thought that the Fed might raise rates, they might not, but they had not in September, so it was looking like they might not do it at all. And then lo and behold, we get the November employment report, and it's somewhat of a blowout. It's very positive. And I think after that, what happened was most of the consensus shifted to that, in fact, the Fed would raise the Fed funds rate a quarter at the December meeting. Now, none of that really mattered to us because what we saw immediately following that jobs report was a spike in rates.
Yeah. Right.
Because the market responds in real time and just assumes it's the buy the rumor, sell the news sort of thing with the market. They assume the Fed's going to do something, they act upon that. I think it will be a sell the news sort of situation. If the Fed does raise rates at the December meeting, I don't think we're going to see a whole lot of change. And rates have stabilized a little bit over the last week, so we're kind of range bound as we have been for most of the latter part of the year. Not a lot of changes. And I did bring a graph, so I think people are.
Show the audience.
Yeah, they're fretting. Can you smell it? They're fretting this as well. But in the 1970s, the average rate was 8.86%. In the 1980s, the average rate was 12.7% on mortgages, of course. 1990s, 8.12, so right there in line with the 70s. And then in the 2000s, believe it or not, it seems a little high. When you take the whole decade, it was 6.29.
Isn't that amazing? So here we are and that was in the 2000s. So
Right.
now we're in the teens, right?
Well,
So
yeah, the
2015 now,
Exactly.
and for the last 5 years ish, plus or minus, we've been
Fours, right?
enjoying 3%.
Yeah, threes and fours.
Yeah, 3s and 4s, and so the average in the 2000s was over 6%.
Yeah. Well, I mean, the early part of the decade, I remember that. I was
Yeah.
starting my career then, and I remember a lot of sixes. I remember telling a guy when we see 5.875 when pigs fly, kind of thing. So there you go. I mean, everything was in the sixes and the sevens back then. But I think home buyers, what they need to take heart of with something like that is we still, even if the Fed raises rates,
Mhm.
you cannot make a strong case that rates alone would be the preventer from moving forward with a purchase if that is otherwise in your plans. I think it's still far too favorable of an interest rate environment to say only rates, if the Fed raises them, would be a deterrent to actually moving forward.
Well, and historically, and it's funny because I've gone to real estate presentations where smart people who study graphs on real estate trends, and this is something that I never realized until I heard it, and it almost sounded counterintuitive, but in every situation in the last 40 years when mortgage rates started to rise, real estate continued to appreciate.
Right.
And in fact, real estate activity actually tends to go up when real estate rates are going up. Now, the reason for that is because it gets the people off the sidelines, and to realize that it's time to act. And it's funny that there would be people like that, but in the entire economy and the way the people move and the economy moves, it's just funny. That's exactly it. So rising rates do not necessarily mean that housing prices will go down. In fact, they will probably continue to increase. Now, ultimately, the affordability index will catch up, and there will be a plateau, and eventually prices might and probably will decline at some point. Because again, cycles are real, and you got to always account for them. But it's interesting that just because rates start to go up in 2016, mortgage rates that is, does not mean that we're not going to continue to see in the Bay Area, particularly, a continuation of 10% appreciation.
And you brought a graph that's really interesting too, and you also said the word that I was going to reach for, and that is the affordability index. So think about that. 10 years ago, you have a graph of the basically the demographic of property price ranges and what has been restored from 10 years ago. But if you're not restored yet from where it was 10 years, and you were paying 6.29 then,
Right.
your affordability is still better, even if we go up 0.5% with the Fed move, if that ever happened. And I don't think anybody's predicting that we're going to see a wild jump in interest rates, even if one occurs. So I think you still have a tremendously favorable affordability equation going on here, and you have nothing to be concerned about with the dramatic rise in rates.
Well, December is going to be good for one thing. It's going to be all the predictions of where mortgage rates will be at the end of 2016.
Right.
But let's just look at what's happened over the last 2 years. So at the end of 2013, it was predicted that mortgage rates at the end of 2014 would be 5%.
False.
Well, they weren't.
Yeah.
And at this time last year, in December of 2014, it was predicted that mortgage rates would be in December of 2015 5%. And where are they? They're 4.
Yeah, so it's the safe bet everybody's reaching for.
Yeah, right.
And
So I'm predicting that the smart money is going to be saying, hey, mortgage rates at the end of 2016 are going to be 5%.
Yeah. This might be the first time, though, that rates increased, at least from a Fed level, whether or not hit mortgage rates.
Right. I do think the Fed is kind of, the story that I remember from childhood, I don't know if any of you guys ever read it, it was a George Orwell story. It was called To Kill an Elephant. Basically, it's Imperial India, and there's a policeman station there, and there's an elephant in the area that starts trampling the market. And so they call the police, and the Englishman grabs his rifle and starts heading out to see what's happened. By the time he gets to the field, the elephant is peacefully grazing in the field, calm, whatever, but he's got all the villagers behind him, and he's carrying a rifle. So he's kind of like, well, I got to shoot this elephant now, because these people, if I don't, I appear weak, and I appear that, I'm not doing anything. I think the Fed's in that position now, where they got everybody behind them, like, okay, guys, what are you going to do in December? And if they
Kill
don't,
all the lawyers.
if they don't raise rates, then people start, maybe there's an inverse reaction where people start thinking, maybe they know something we don't, maybe. So I think the Fed's really in a pickle. I do expect them to raise a quarter. I don't think
they can't do a half. It's too
No
big
way.
a percentage
No way.
based on.
No, and I don't think the bond market reacts violently to that in any way that we don't already or haven't already priced in.
Got it.
Yeah.
So I've got we got a few more minutes here, and just wanted to share with you a great graph. I actually shared this a few weeks ago on the Best of Investing. But I like these graphs so much, and assuming you haven't listened last time, this is a 3 graphs that show where housing prices in the San Francisco Bay Area are today relative to the peak in 2008, and this is not probably going to be news to a lot of people, but for homes over $1 million, home prices are 17% above the peak in 2008.
Okay.
Now, for homes in the Bay Area that are selling between $500,000 and $1 million, on average, they're the same as the peak. The index from 2008 to today is the same. This is the Case-Shiller mid-tier home price index. For the low tier, for homes below $500,000, of course, you've got to kind of search long and hard in the Bay Area for homes under $500,000. But for those homes under $500,000, they are still 23% below the peak in 2008. And when you look at these graphs, what it shows you is homes below $500,000 had the largest bubble surge in valuations, much more so than those in the mid-tier or high-tier home prices. So the biggest, and it's really a shame because the people who got hurt the most were entry-level home buyers and people in that low-tier home price, and it's really a shame that the rich people really didn't get hurt all that badly. And
Well, I think that also takes into consideration where people go to find houses that are affordable. So as they run further away from the city where there are more development, more houses available, they tend to be in price points that are more accessible. And so you have a run up in those. You have more buyers, searching for more homes, but still, supply and demand is more out.
right. So again, the argument against the bubble is really it's just the homes above $1 million that have appreciated dramatically, and the people who can afford homes above $1 million, they don't really care. They're not really exposed to bubble pressures.
Yeah.
All right, guys, here's our thoughts for the day. Victory belongs to the most persevering. Napoleon said that. And, you've heard the term, money talks, but all mine ever says is goodbye. All right, tune in next week to The Best of Investing. We're going to be giving away more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.
I would think the best shows are when you're on, Rob, because it's really good real estate banter.
Well, you make it a lot easier for me. So I've been on the show by myself, and it's kind of like, whoa, I'm missing out. Dialogue.
The first few times Edward and I did shows by ourselves, and we were, it felt like stretching. Yeah,
A little bit, yeah.
So.
It's always very.
It's three
It
or
makes you admire the
people.
guys that hold a radio show, even sometimes by themselves.
Yeah.
God, damn, how do
You
you do
just
that?
keep coming up with stuff. Well, they read the paper, and they just kind of come up with stuff as they.
You also have to have a lot of confidence that you're interesting, because once you stop
Yeah.
feeling interesting, I'm sure the audience does.
How was the Will Durst guest show?
He's good. He's funny. I like making him laugh.
Was he live or on the?
He was. He didn't come in this time.
Oh,
He
okay.
called.
Yeah, got it. Oh, and it wasn't the first time.
No, he's been on before. He actually came in the studio last time.
Nice.
Yeah. Oops.